Closed Loop Partners is an investment firm and innovation center focused on the circular economy. We're structured to be able to invest anywhere along the growth trajectory of a solution. We can look at bottlenecks in supply chains, identify solutions, identify the right type of capital for that solution, and then focus on solving that bottleneck.
Our mission is to increase the amount of material that remains within the circular economy, reduce carbon emissions, and reduce impact on the natural environment. And those three things are integral to all of the investments that we might look to make, and all of the technologies that we look for embody the ability to meet those three goals.
What I wanted to do was create systemic change, help enable systemic change in the apparel and textile industry, which was a $3 trillion industry. So it's massive. And for me as an outsider, I wanted to focus on a single industry so I could really understand, gain the intel, partnerships, the expertise required to pick the right companies and scale them.
Maybe you could just start out with a high-level overview of Closed Loop Partners and what you're doing, what your mission is, maybe at the 10,000 meter level right now, just to frame it.
Closed Loop Partners is an investment firm and innovation center focused on the circular economy. We're structured to be able to invest anywhere along the growth trajectory of a solution. We can look at bottlenecks in supply chains, identify solutions, identify the right type of capital for that solution, and then focus on solving that bottleneck. And we try to do it in industry verticals where we have deep expertise or our corporate LPs are prominent. So consumer products and packaging, food and ag, fashion apparel, and electronics.
Do you have separate funds?
Yes, we have separate funds. We have a venture fund, project finance fund, a growth equity fund, and a PE fund.
And are these open-ended or are they closed-ended?
They're closed-ended.
And do you disclose your AUM?
We don't disclose our AUM, but it's in the hundreds of millions.
And is it mostly U.S.?
Mostly U.S., but we have a major focus in Israel and an operating partner in Israel, some investments in Europe and one investment in Latin America.
So is it 4 separate funds or do you have?
There are 4 separate asset classes that we manage. We have 7 funds that we manage because some of the asset classes have more than one vintage at this point.
Do you have certain benchmarks that you target for each of these classes? Or
we're either targeting for a net 15% or net 20% IRR.
Do you consider yourself to be more VC or more PE, or is one more stronger in your wheelhouse than the other?
No, that gets back to my comment around I don't necessarily view myself as an investor, quote unquote, building the circular economy. And that means that I'm using an investment platform to build out the circular economy. And I find all of those asset classes to be interesting.
Did you start with one?
Our first fund was a credit/infrastructure fund.
You said you're exclusively focused on the circular economy. How do you describe the circular economy and how would it differ from the linear economy?
Linear economy is structured where extractive resources, oil and gas, mining, and the landfill industries dominate in terms of value creation. In order to manufacture anything, you need to extract a natural resource. It's usually designed to be used once and then disposed of in landfill. And then the next unit you manufacture, you have to extract natural resource again. You have to then dispose in landfill. And that type of system, while it's in the best financial interest of the extractive industries and the landfills, it's not in the interest of taxpayers, consumers, consumer products companies, or municipalities. What's in their interest is a circular economy where you're constantly reusing material in a sustainable loop.
Your funds are exclusively focused on the circular economy. And so my question is, how do your funds represent an attractive or more attractive investment opportunity versus, let's say, a traditional VC fund or PE fund, or even one that's ostensibly environmentally focused VC or PE fund?
Because we believe that we're investing in where the market and the economy is moving, and that we have proprietary insights in terms of that direction because of our corporate LP base. And so why invest in us? Because you're going to have the best returns in the market in investing in our funds, along with feeling like you're investing in products and services that are beneficial to your community and the world. That's very, very important to me, that people begin to recognize that investing in either a circular economy or in sustainable products, returns will be far better than the alternative.
So in the end, you believe it comes out in the wash with the financial returns. I mean, it's a clear financial competitive advantage.
I'll give you an example. And this is a cognitive dissonance that exists in the financial services industry. People like to say it goes back to Milton Friedman, but I think it goes back before then, where it's believed that the sole job of someone in the financial services sector or an industry is to just make as much money as possible without any other consideration. So let's take that notion and put it through a investment strategy. If I started a fund in 2000 and I said, I don't care, I'm investing in the greediest, the most capitalist, the most boisterous CEOs and companies out there who just take pride in just being aggressive and grabbing as much as they possibly can. And over here, I've got another fund that it's really focused on aligning itself with companies and CEOs that believe that they operate within a community of stakeholders and have to build value for everyone. Let's look at those two funds. What I would probably have in the first fund, or at least would never have screened out, would be Enron, WorldCom, HealthSouth, Tyco, and a bunch of mortgage-backed securities. And I'd probably still be holding a lot of fossil fuel stocks, which are now tanking. On the other hand, this other fund that was focused on ensuring that there was value for all stakeholders and how I operate would have companies like a Unilever, where Paul Pullman made sustainability and circularity a key of his management style at Unilever and far exceeded the returns of his competitors. You'd have companies in there like SodaStream that Pepsi acquired for $3.4 billion, companies like Seventh Generation in there, Method Cleaning Products, so on and so forth. So it's been my view, and I think the data backs this up, that not only are you going to end up investing in companies that outperform the market, equally or more importantly, you're going to screen for companies that are either long-term going to lose significant value because of something that they're doing that they're not exposing the market to, something that they're trying to hide, or because they just don't recognize where the world is going and are planned for it.
Eventually, it's going to come out in the wash. I mean, there's going to be companies that don't adapt to this are not going to perform financially as well.
Yeah.
There's people that still have a hard time getting their head wrapped around that, or at least the data isn't always clear cut.
I have chief investment officers today of endowments that go, I feel really good about myself because I've now decided to get out of fossil fuels. And they want to be patted on the back. And I go, well, there were papers that came out a decade ago talking about how fossil fuel assets were stranded assets and you should get out of them now. And Jeremy Grantham, who's been one of the most successful investors for the last 75 years, has been saying that for 15 years. And so I tell these chief investment officers, well, before I pat you on the back, let me ask you something. Has anyone done an analysis of 10 years ago when people started talking about these fossil fuel assets or stranded assets? Has anyone looked at if you would have made the change then and moved into renewables versus staying in fossil fuels? Yeah. What would your fund performance be? Like maybe we shouldn't be patting you on the back. Maybe we should be pushing you out the door. Maybe you got to this just way too late. And so I think we have a problem in the financial services industry where there's way more urban legends and myths and cognitive dissonance than is healthy for the long-term value that shareholders expect.
You said you ended up focusing on 4 key sectors. I think it was plastics and packaging, fashion, technology, and food and agriculture. How did you end up focusing on those as the place where you can maximize your impact as an investment firm?
It had to do with the professional experience of my team. People ask us sometimes, why don't you do the built environment or why don't you do medical waste? And literally a lot of it has to do with just, along with successful fund managers, we're mostly former CEOs, CFOs, heads of municipal agencies. And so we try to invest in things that we know.
So let's talk about closed loops investment strategy and your investment process. Could you maybe describe logistically and tactically or operationally, how do you identify your targets and then get down to actually selecting an investment and make your investment decisions, what screening processes you use, both financial and non-financial?
So I'm a big believer in value investing. So we try to ensure that each one of our funds is a very strict price to value discipline, as opposed to just like, hey, this is a cool company. Let's try to evaluate if the valuation is correct. We try to say within this asset class, this is our price to value ratio that we're comfortable with to make an investment. And so sometimes we see investments where we really like the companies or we really like the CEO, but just doesn't fit our price to value discipline. So that's the first thing, is we're always looking for, does it fit within our investing model? And that doesn't mean that we don't miss investments sometimes, but what it does mean is that we optimize our time and our focus and our expertise on specific market segments and sizes within those markets.
So that's the initial screen, but then you have non-financial screens as well?
We have non-financial screens that involve how circular is the company? What kind of impact is it having? How many tons is it ensuring don't go to landfill? How many tons of GHG emissions are they reducing? So we definitely screen for the social and environmental impact of the company, not in an esoteric way.
Yeah, I think in your 2020 report mentioned that since 2017, your venture team has seen something like a pipeline of over 2,500 opportunities, but funded 19. Those are not great odds.
Now we're closer to 30, but yeah.
And so now I presume all of these were circular economy companies, or I imagine you wouldn't have wasted,
something about it to do with circular.
So what are the funding prospects out there for, the companies you didn't invest in? Is that because you determined they weren't good, really circular economy companies, or are there other sources of finance for them?
On the venture fund side, probably the biggest screen is that we'll only invest in a company where the post-money valuation is below 10 million when we invest.
Yeah.
So that's probably the biggest screen, is just an interesting company. It just doesn't meet our investment model and price to value ratio that we need. So that's probably the biggest screen. Then the next screen is generally, is this a technology that can be advanced to the stage where it's a business? So we're always asking the question, what problem is this solving for somebody that would pay to have the problem solved? Because there's businesses or governments that have problems, or just they're not motivated for whatever reason to fix that problem. So you got to make sure that the solution is a good enough of a solution that the buyer, whether it be a business or a family or an individual or a government, says, wow, that really solves a problem for me. So that's the next screen that we're looking for, is that transition from cool technology to legitimate business. And then you start screening for the entrepreneur or the CEO and other factors. But those first two will weed out a lot of that 2,500.
Could you give me, one or two examples of an investment that is the type of investment that is a circular economy investment that you selected, is very representative of what you look for?
Sure. We were the seed investor in a company called Home Biogas, which is a company based in Israel, which has since gone public on the Tel Aviv Stock Exchange. And that's a company that has developed household-size anaerobic digesters. It's an appliance that goes into your home or your backyard. You put food waste into it, converts it to gas that you can use to heat your water or to cook on.
Now, how did they come through your funnel?
It was a solution that I had been looking for and actually been writing about. In a parallel universe, the founders and CEO were developing it. And as luck would have it, we got connected and we became their first investor, and they've done a great job.
That's interesting. Do you have one more example, perhaps?
Sure. Cool company on the early stage. There's a company called Mori, Mori, which came out of MIT. And it's developed a odorless, tasteless, edible silk protein that goes around fruits, vegetables, meat. You can't see it, can't smell it. You could digest it if you wanted to. It eventually evaporates into the atmosphere, but while it's on there, it's creating an oxidization barrier to reduce spoilage. And so it's a perfect example of using material science to get rid of all the plastic packaging involved in supply chains and storage of foods.
And your exits, are you primarily going to corporate LP buyouts, or is it completely third party? Do you have corporate investors or not?
Yeah, we have corporate investors. That's a possibility. To date, the exits we've had have just been traditional buyers who have gone after it.
Now I'd like to shift a little bit to discussing impact. And in my research, I've read that Closed Loop has very impressive impact outputs. I've found where you have said that you diverted 2.3 million tons from landfills. And landfills are the third largest source of methane emissions. And you've avoided 5.3 million tons of greenhouse gas emissions and created an additional 16 million in economic benefits to municipalities and local communities by avoiding landfill tipping. So my question is, how do you verify impact and what does it mean to you and how do you measure it?
That's a good question. So what we're looking for in terms of impact is the ability to reduce extraction of natural resources and disposal in landfills. So any investment we look at, whether it's an anaerobic digester or material science company or recycling facility, we're always looking at it through the lens of, is this investment going to reduce the need for natural resource extraction or disposal in landfills? That's what we look for in terms of how we want to have impact. Number one. In terms of how we measure it, we have certain criteria that we ask our portfolios to report on in the areas in which we think they're having impact, whether it be how much recycled material did you use so that we can measure that those are natural resources then that weren't extracted, or how much of your product was recycled, or if you're a recycling company, how much are you recycling, which represents material that could have gone to landfill, but instead went back to the supply chain. In our financing documents for the company, they're required as part of the investment to report on their numbers.
And is the reporting straightforward?
Generally pretty straightforward because it's things that we work through when we put the investment together. So it's not like we're coming to the company and saying, do you think XYZ? It's as part of the diligence process, we said, are you going to be able to report on the following and are you comfortable doing so? And could you show us how you would do that? There's lots of companies that can't, and we don't end up investing. So by the time we've made an investment, we feel pretty good that there's a very concrete understanding about structure.
As soon as you have a report card of some sort, then there's going to be some actors out there that will game the system, of course.
Yeah, it's a challenge, but that's what we're looking for in our diligence process. And look, there's no shortage of companies looking to raise money by greenwashing, and no shortage of funds that are looking to raise capital and just greenwash and put the capital to work. So we try to let those guys find each other and do their thing. And
could you give me some examples on how you do measure it, though? Maybe they're not all similar, but could you just give me one example?
So if you take a recycling company, we're having them report on all of the tons that they're processing by material type: paper, metal, glass, aluminum.
Mm-hmm. That's in, and then you measure what's out.
Yeah. Well, we measure what comes in, we measure what comes out. We also measure how much more were you able to process post our investment.
And are most of your investments involved in recycling?
A lot of them are, but we're really focused on supply chains, and recycling is a big influencer in supply chain management, but just a piece of it.
Who are your fund's typical investors? And I guess that depends which fund we're probably talking about. Yeah. And why do they invest with closed loop? Is it out of passion, or is it because of the returns, or is it both, or maybe it doesn't matter?
We have a lot of corporate investors, and they're mostly interested in us building out supply chain solutions for them. So they obviously look at their returns, but what they're most interested in is making sure that our investments are creating supply chain solutions for them, because those supply chain solutions are ultimately going to make them more money than our returns, which are very healthy. We return in the upper teens and 20% returns. So that's what they look for.
Right.
I would say the other investors we have are family offices, financial institutions, and foundations. I think they have a combination of, they want strong financial returns and to make sure that their money is invested in something that's creating some type of benefit and no harm.
I'm interested in the corporate investors you have. When you say they're interested in supply chain solutions, is that essentially like you're innovating their pipeline?
Sometimes we're developing innovative new solutions. Sometimes we're just getting solutions to scale. So we invest in a company called Our Planet Earth, a bottle-to-bottle recycling facility in California. It was $150 million financing with Oaktree and Citi and the state of California and us. Our corporate LPs really care about that facility getting built because they want that material. They're just not in the business of financing manufacturing facilities. And so it doesn't get built if someone else doesn't step in. And so they look to us to help with that.
Have you had any exits to any of your LPs?
Exits to our LPs? No. We've had exits, but not directly to our LPs.
All investors are exposed to similar risks in terms of market and so forth. Are your investors exposed to any risks that you would describe as being unique to investing in the circular economy versus, let's say, a traditional PE or VC?
But what makes what we're doing unique is that we have the brands giving us proprietary insights in terms of where the market's going. So our thesis might be idealistic and aspirational in that we want our investments to do better for the world. But on the same token, maybe we're not idealistic or aspirational. Maybe we're just realistic about where the world is headed because our corporate LPs, who are the largest CPG companies, are telling us where they're trying to go, and we're trying to put money behind that direction.
How does that translate to risk?
There's risk inherent in any investment. There's risk in the person you're backing. There's risk in the market. There's risk in the product. But I think investing in the circular economy, at least today, is a way of actually de-risking your investment because you're investing in the direction of where major industry is going.
I wanted to change the subject a little bit, discuss the genesis of your innovation center. Maybe you can explain a bit, what is it and how did that come about? And is that like a R&D for you, or is it a cost center? Is it a profit center?
So pretty early on in the formation of our company, our corporate started asking us for advice and recommendations and suggestions on different challenges they were having. And so we started offering this advice and different suggestions. It started growing and growing. And so I recognized that, hey, we have a business here. We could be offering advisory services and research and development. And that really became the seed for the Center for the Circular Economy. And then I got somebody that I worked with very closely in the Bloomberg administration to join me to lead that, which helped significantly, Kate Daly. And then since the business had kind of an ongoing platform to jump into, because of the work the firm had been doing, it's been able to take off and do really well.
So it's a separate profit center by itself then?
Yeah, definitely. Separate profit center that's done very well for us.
Is it turned into it being synergistic as a competitive advantage for you?
Definitely.
I mean, can you
have
give
a
an
group internally that's thinking about where things are going and what's happening without the pressure of, am I investing, am I not investing? They're just evaluating it from a pure industry analysis scenario.
And these initiatives are funded then by third parties outside?
Yes.
And then have any of these developed into something that you ended up funding and seeding through the VC to your VC arm?
I think it's definitely given us data and insights that's led to investments. The center's been very helpful to us because you have this internal group that's working on bottlenecks where there aren't investment grade solutions yet. If there was an investment grade solution, our asset management team would be investing in it. But it's a bottleneck that the brands have told us about, and we haven't been able to find an investment grade solution. So now the center works on, why isn't there a solution? What's required for there to be a solution? Is there a solution, but just needs a little tweaking? So having that type of innovation and insight group within an investment firm is really helpful because it tells us where some of the biggest opportunities are, as well as some of the challenges.
You say the recycling landscape in North America is fragmented. I live in Europe most of the time. Could you explain what that means, that it's fragmented, and how does it compare to what you know to be true in Europe?
It's not that dissimilar, actually, from Europe in the sense of, if you look at Northern Europe, you've got really good recycling infrastructure. Yeah, if you start going down to Portugal, Greece, southern part of Italy, better than in the US, but not that good. And so what you find in the US is that in major metropolitan areas, you have good recycling coverage. And there's also plenty of places where there isn't good coverage. And so it's very difficult for brands to come up with a national strategy in the US because there's no national partner for them to partner with that can service them everywhere.
What would be the solution for that?
Scaling up a regional or national circular economy company, which is something that we're very focused on doing here, actually.
That, though, being private as opposed to public?
Private to start off, but I could see it eventually being public.
I spoke a little while ago with Jed Emerson, and he described how he feels that we as a society have done a pretty poor job at pricing in ecosystem services into the economy, and that many companies are offloading their environmental costs onto the public. Companies that are viewed as being very profitable are less profitable because they're effectively paying this ecosystem rent at artificially low levels. To what extent has that happened? How big of an issue is that? And what could be done to correct that?
It's a really, really big issue. Just to give you an example, the fossil fuel industry, which is the maker of plastics, receives $20 billion a year in local and federal subsidies. And so when you're giving an industry that much money, it can artificially keep its prices low and make sure there are not alternatives at scale. And if the U.S. took the money it gave in tax subsidies and other subsidies to dirty industries and shifted that over to sustainable and circular industries, you'd see a tremendous growth. Over the next 5 years, they could say, we're just going to spend $100 billion on sustainable solutions and renewable energy and circular economy. $100 billion over the next 5 years doesn't cost taxpayers a cent. All we're doing is shifting that money from petrol over to another industry.
What about changing the way these companies account for these costs? Or will the market effectively just drive them out anyway, or drive them towards circular?
It'll drive some towards circular, some will fail. But the bigger problem is a lot of these industries have only been profitable because they've been getting subsidized by the public.
So if you're saying if we get wiped out those subsidies, things would change almost immediately or redirect.
Absolutely. Yeah, like one of the great scams in American history is that the CEOs of ExxonMobil got to make a lot of money and sort of pound their chests as the titans of capital. But in reality, behind the scenes, they were really on the dole. They were collecting government subsidies for their businesses. And I think getting rid of those types of subsidies or making sure everyone has it would go a really long way in terms of evening out the market.
You're committed 100% to the circular economy. Are you up against powerful forces who have vested interests in the traditional economy and are actively lobbying against the circular economy?
There's definitely some opposition. I wouldn't necessarily describe it as they used to be winning, but I think the tide has turned and now they're fighting an uphill battle. But there is definitely opposition from the extractive industries and the landfill industries. Those are the two industries that don't want to see this change happen.
But are they actively applying resources? All your AUM is focused on moving this forward. Are they applying AUM against that? And is this David and Goliath, or what is it?
Good question. I wouldn't think that they're applying it against us. Some cases they are. In most cases, they're just trying to keep growing the legacy footprint that they have. And so in that sense, like we compete, we butt heads, but not because they're trying to do what we're trying to do or we're trying to do what they're trying to do. It's that we're both going after the same pie.
Why the name Archipelago?
I know it's one of those things that seemed really good at the time because it is the idea of many small parts becoming some equaling more than just the sum of the parts. They are something bigger when you join them together. But of course, nobody can spell it, and most people can't say it. So it's a slight misnomer, but we like it. We've stuck with it.
Give me a high-level introduction and overview of Archipelago Eco Investors, and then there is Archipelago Ventures. And I'd like to also understand the difference between the two, but like to know what are their missions, their main activities.
So I guess we should start with our mission. We obviously, like any young founding team, we try to figure out what that mission needs to be. And for us, it is to increase the amount of material that remains within the circular economy, reduce carbon emissions, and reduce impact on the natural environment. And those three things are integral to all of the investments that we might look to make, and all of the technologies that we look for embody the ability to meet those three goals. We have two businesses. So Archipelago Eco Investors is the main holding company, and it's that company through which we are raising a fund, and that fund is focused on the circular economy and particularly materials, with a strong bent towards plastics because it's very much of the moment, and it's certainly a space where we're seeing a whole load of innovation. But it also includes things such as construction materials, for example, or microplastics. Many different facets fall under the circular economy. And we're in the process of forming that fund. But while we do that, we have our Archipelago Ventures. And the reason we have ventures is that in the journey that we have taken to raise that fund, we have come across many difficult issues around timing in particular. Being faced with a pandemic and with the Ukraine war and the uncertainty around that, it's a very difficult time for venture. What we have is a number of really committed, interesting investors who'd made commitments to the fund. And you're probably aware, Scott, you need to get to a certain point, a certain scale in order to make a fund efficient in terms of economically run it efficiency. We did not feel that we were going to get there fast enough. And if we were to wait, we would lose some of the opportunities that we could see in front of us. And obviously, when you're raising a fund, you're out there, you're talking to so many startups, amazing tech entrepreneurs. We could see their opportunities for us to be making investments right here and right now. So rather than wait and go through that journey to get to 50 or 60 million and get to a point where the fund was really at a good size, which it really needs to be right now in the current environment, we decided to be a bit more creative. So we have launched our first accelerator, which is with one of the investors who made a commitment to the fund. It's called RAP. You might be familiar with it because it's also an NGO that's doing a lot of work in Mexico. And RAP have developed a lot of the underlying work and implemented the plastics pacts. So when you talk about the UK Plastics Pact, the Chilean Plastics Pact, a lot of this work comes from RAP. And they were initially part of the UK government. They were spun out a number of years ago. They invest for impact, and we're very closely aligned with them. So when we were thinking about, how do we creatively channel this capital that we have sitting in front of us to the opportunities that are sitting in front of us, we were very open with a number of our investors and said, look, if we do things this way, would you be open to it? Would you help us to be creative and actually therefore achieve the impact sooner than we might do if we just wait and start the fund in a year or so? And to their credit, they said yes. Said, absolutely, let's go for it. So we launched the first accelerator last year. We're about to launch a second accelerator, which will be an oceans plastics and microplastics accelerator. I won't say who it is yet because we haven't actually launched it. There'll be accelerators 3 and 4. And all of those strategies have a very clear focus on the impacts they're trying to generate. So what we started to understand when we were raising the fund is when we talk about circular economy and when we talk about plastics, it means different things to different investors. And I don't mean, some of them want to achieve a hurdle of X and some want a hurdle of Y. I mean that RAP, for example, wants to accelerate the amount of technology solutions that are available to bring more waste in the UK back into recycling, for example. Whereas the Oceans Plastics Accelerator, really looking at microplastics and the impact that it has on oceans and waterways. It wants to find ways to keep microplastics out of the oceans or filter it, or find ways in which it can incentivize companies not to pollute in the first place. And it can be things from paint inhibitors through to one of the investments we're hoping to make later this year will be about collecting paint flakes, microplastic paint flakes, in the process of which they are sanded off as steel construction, ships, oil rigs, for example. It's a capture system which allows for the paint flakes that would ultimately go into the ocean and actually make up a significant proportion of microplastics in the ocean at the moment to be safely disposed of. So there's avoidance technologies in there. But those two impact goals are not the same. And What we understand now is that we have an opportunity to achieve the impact goals of particular investors through this different types of different methodology for investing that we would not necessarily be able to do in a fund. They would not always get what they wanted in a fund. 60% of it might meet their impact goals, but 40% would probably be peripheral to them. And we really like the way that this is turning out for both for them, but also for us. We've had so many inquiries from other investment groups saying, it's really interesting you're not using a fund model for this. We've been thinking around this for some time, but we hadn't really figured out how to do it yet. And it's interesting for them that we are almost turning it on its head and saying, okay, let's give the client what they want. And I think some of that comes back to that grounding I had at Cantor's, which is if the client wants something, you find a way to make it work in an efficient fashion. You don't just keep going and saying, well, you just have to trust in us. This allows us to actually give them what they need.
Who are your investors?
So we don't tend to disclose an awful lot. We can very actually talk about RAP, for example, but we also have family offices who work with us, less so on high net worth individuals, although they do come alongside us if we're making a deal. We have a great network of investors who would like exposure to the kinds of deals we're working on, but who would not feel confident in doing so themselves, or perhaps their ticket size is not quite big enough. So we also look to crowd in as much capital as we can to investments. And we will do so in the form of SPVs, for example, in making it available to those investors. It also helps to raise the profile for the startups we're working with. They're relatively young startups. They don't necessarily have the bandwidth to go out to a great number of investors because they don't necessarily know who they are. This is possibly one of the first times they've done this. So we make it possible for them to get more funding. And we're very open about the fact that we recommend other VC investors to talk to startups, for example, or we'll issue an LOI in order to help them get a bit further in that conversation to say, I've got an LOI from these guys and they're willing to put in X. Will you come alongside?
So you're saying primarily family offices, but you also have other investors, like you receive funding from ICFA.
We did, yeah. So that's more seed funding, really, for us to bring the fund into creation. The International Climate Finance Accelerator, or ICFA, has an end goal of trying to attract as many funds to Luxembourg as it can so that it can become the sustainable finance center in Europe. And part of the way that it facilitates funds coming to Luxembourg is to make available seed funding and a really interesting program of tuition and mentoring through the International Climate Finance Accelerator. And we were really fortunate to become part of one of their cohorts just before COVID. What it does for us is it goes well beyond the financing aspect of it. It enables us access to a lot of information, which as a first-time fund manager, pulling together all of that advice and information to form the best possible fund that you can is really important in the most efficient way that you can. But also access to a whole cohort of interesting investors who are all doing different things. None of us are doing the same type of fund, taking the same approach, working in the same geographies. Therefore, there's no competition. And we form this really tight network of groups who want to see each other succeed. So we're very open to swapping information, war stories, saying, actually, you know what, you should do this. You should talk to these guys. These lawyers will give you a much better rate. It's worked extraordinarily well for us, and we're really proud to be part of it.
I believe it's the Circular Accelerator that you have the partnership with RAP.
The Circular Plastics Accelerator. That's right. Yeah.
Is that an exclusive partnership?
It is an exclusive partnership in that WRAP have trusted us to run the allocation they had made to the fund in this accelerator. And that gives us the ability to make, in the next, or in the 12 months since we launched last year, 4 or 5 investments, one of which we have just inked last week, which I can tell you a bit more about, 2 of which we are in the process of taking through IC, in order to deploy quickly and efficiently to the startups who had been in our pipeline, who we'd familiarized WRAP with, and who meet the goals of WRAP's own targets, increasing circularity, circular materiality in the UK, increasing the ability of materials to be recycled and actually be recycled. There's recyclability and being recycled are 2 very different things. And ultimately, to increase the amount of infrastructure that will be available, particularly in the UK, to keep as much material within the circular economy as they can.
Other accelerators, the Oceans Plastic, does that have a partner?
It does have a partner, which we will be announcing very soon. Very soon. It's a very influential family office that we are so proud to be working with. And they have very clear goals around oceans health. So a number of their strategies are working in very distinct and very different areas to us, but they have a real intent behind backing us, which is to enable us to identify and support the types of technologies which will ensure that microplastics either never enter the ocean or are removed from the ocean.
For listeners listening to this, we are recording this in April 2024. So next month, May 2024, this will be announced, right?
It will do indeed.
So you're focused on the circular economy. So I want you to explain what the circular economy is. How does it differ from the linear economy? Why? Because of your specific focus on plastics, recycling, and waste management. Why does this represent a solid investment opportunity versus a traditional or environmentally focused VC fund? Some years back, I did a raise for a client who processed municipal waste into organic fertilizer. And the beauty, at least the way I sold it, was that their revenue did not come from recycling. They were quite specific and maintained that the economics weren't there for recycling. And they claimed to me that there's too much waste to be recycled and it couldn't be done profitably without subsidies. Now, first of all, I don't know if you feel that those are truthful statements. And secondly, this specifically your focus on recycling plastics.
So the circular economy, in the shortest way I can say it, is ensuring that materials remain in the economy rather than expecting to consistently use new natural resources. It's a recognition of the fact that natural resources are not infinite and that it is more environmentally effective to not draw natural resources. Effectively think of plastics coming from oil and gas feedstocks. It's much better if we can just keep those materials in the loop as much as possible and reduce our reliance on fossil-based plastics, for example, but other materials too, because every new material is going to have a higher carbon footprint than a material that can either be used in its present form again or can be recycled and used again.
Now, tell me about the state of play of plastics recycling and this statement that we can't keep the amount of plastics available for recycling in the economy today. Is that a true statement or not?
What I would say is it's very complex, and bringing into the light the story that you shared around the economics not working, that is true. At the same time, it is true to say that regulation is moving in only one direction, we are only seeing a tightening of regulation around what materials can go to landfill, what materials should be sorted at source, what materials can be entering the market. For example, in France, they're putting a tax on new fast fashion, anything which is high turnover, not meant to be used for very long. Most textiles contain some type of plastic. It's one of the secret hidden areas in which plastic is so prolific in our environment. That tax is really important because it's a signifier as well as a way to discourage fast fashion from being put onto the market. We see that direction of travel as only going one way. We are not going to get to a point where suddenly it's cheap again to landfill materials. It's just not going to be. The gate fees alone are increasing such that certainly in the UK and Europe, less in other jurisdictions, but certainly in the UK and Europe, we are only seeing those taxes going to increase. We're also seeing European directives which are requiring waste to be better sorted. And once it's been sorted, it can't just be dumped. Something has to happen to it. And that applies to plastics, it applies to textiles, it will apply to bulky waste and to construction materials over time. There are also other things coming into play, like extended producer responsibility. So the kind of costs that are needing to be borne by brands and retailers when they put products into the market, because you can no longer just say, once it's put on the market, it is no longer my responsibility. There are costs inherent in that process that are coming into force, which are going to change the economics for some of these products. And it may mean that business continues as usual, but those products go up to incorporate those costs. But ultimately, there's going to be a point where the pressures from consumers are going to say, we don't want to pay just because you don't have an end-of-life solution for your product. Do better. And we're seeing this throughout the economy. There's only so many brands that you need to look at before you see a recycled content in textiles label. Now, the fact that actually that isn't a great thing, it's one of the things that we can touch on in a moment. Everyone is trying to move towards a position of being able to both offset their potential taxes and also increase their social license to operate, retain their consumer client base, retain their sales. So we see this as being a sector where there's enormous potential for growth, both from the carrot and the stick. And that's why we think actually when you remove the dynamic of is it cheaper to buy virgin or is it cheaper to buy recycled content at the moment, that's something which is going to flux. But all of the regulatory issues around what you do with the material at the end of its life is going to be really important to this dynamic.
By raising taxes, that just makes it more expensive on the consumer who might push back on the brand. But that money going to the government doesn't necessarily end up reducing the amount of plastics that are being recycled in the economy. It could often end up being spent in ways that have nothing to do with all that. So don't we really need to do something that actually increases the actual use of this plastic in the economy as opposed to just make it more expensive? That's just increasing opportunity costs as opposed to actually solving the problem.
It's a really good question around where that money goes. Does it go into Treasury, into a general pot? Does it go towards increasing infrastructure? Does it go towards other areas, waste management, for example? At the moment, a bit like the European Emissions Trading Scheme, profits from the sale of EU allowances goes into a general pot. And there isn't an allocation specifically in the UK for that money to be spent on recycling infrastructure. You're absolutely right. This is obviously something that is talked about a lot. How does that money get spent? That's not to say the UK isn't providing substantial grants for many of the young startups that are coming up with solutions which can address some of these problems. But I think what's helpful here is to characterize the types of solutions and also the problems that are faced. So at the moment, if you take films as one of the predominant waste plastics that don't get recovered and recycled, part of the problem is that a lot of films can't technically be recycled because they're composites. So you need a technology set that can both separate those films from general waste or from a recycling stream. And you need to find technologies that can do something with it. And whether that's mechanically or whether that's chemically transforming them back into materials that can be used again, both of those solution sets need to evolve over time. But there hasn't been the impetus for those technologies to be developed up until recently because regulation wasn't there. So, of course, no entrepreneur is going to find a solution for a problem that hasn't really been identified. It's only now, since really 2018, 2019, that we're seeing the technologies that are emerging come through that development cycle from TRL4 up to TRL9 that enable brands to say, okay, I can understand what's going to happen to a material when I put it on the market. There's also not been a requirement for a brand to design with recycling in mind. So both of those things are happening, but at the same time, technology needs to catch up. And that's exactly the space that it is starting to catch up. It's really well understood that textiles is an area where consumers will be quite happy to pay a bit more for recycled content within a piece of textile, with your shirt, your jacket. But once plastic gets into textiles, whether it's the fabric on your sofa, whether it's your jacket with multiple zips and multiple different types of fabric as the outer and the inner layer and the zip, you cannot extract that plastic from that composite material. You can't very easily deconstruct a jacket that has those multiple components to it. You can't easily deconstruct a sofa that has intact recycled content fabric with all the different components, the foams, the timber, the springs, etc. All of those solutions need to evolve the deconstruction, but so do the technologies that will allow for the nylon component within a jacket to be separated from any organic component, or to enable nylon to be recycled. And actually, those are the kind of technologies that we're looking to back. So we're looking for those really interesting approaches that will allow that material, once sorted, to be recovered, because there is going to be an end market for that particular output. And we use plastic as a very generic term, but it's so nuanced. There are so many different types of plastics and end uses for those different types of plastics that you do need a whole range of different solutions that can unlock this.
You mentioned textiles, and I suppose that also gets into the fashion sector. Are there any other key sectors of circularity that you're focused on?
We are very focused at the moment on sorting and separation technologies. So in 2022, we made an investment into Grey Parrot, which has become quite a well-known startup here in the UK. They're doing extraordinary things with both AI and data and enabling sorting of recycling streams to be done to a much higher granularity to generate much purer content. Effectively, what they do is they build a very sophisticated AI model that recognizes all the materials that are on a MRF, a refuse facilities belt. And as they travel along, they recognize each material, whether it's dirty, whether it's got a label on or not. The AI enables the recognition of that material such that it can be sorted using robotics or through air-blown sorting. Once you can sort those materials, you can get purer outputs, because if you have all of the same material in one particular area, you can then sell it for greater value, and that can be recycled into an end material which has a much higher purity level, which you can't do right now. But also, really interestingly with Grey Parrot, it generates data. So that data will enable the brands to say, okay, so Pepsi, 95% of the bottles going across the market at the moment are ending up in MRFs and they're being recycled, or only 45% are. And at that point, the government can both modulate EPR fees, but it also is a really clear statement that says, well, you, particular brand, need to do something better because your product clearly is not making it into the recycling stream. Therefore, it can't be recycled. We're actually just making another investment. It'll be announced by the time the podcast comes out, into a company called Sorted, which is also using AI to identify materials at a MRF. Again, the same concept. The materials travel along the conveyor belt, but this time, instead of working at a very high-tech level, it works at a slightly different level in that it augments human pickers' ability to identify materials. It uses what's existing. So at the moment, most MRFs in the UK and throughout Europe have pickers there. And it's a pretty unsavory job. It's often transient workers. It's people who don't stay for particularly long. They do need training. English may not be their first language. They have trouble identifying what materials are going across the line. And it's quite a skill to be able to identify one bottle and its composition from another. What Sorted do is they use their AI and spectral analysis to identify what an item is, and they shine a light on it that's a different coloured light for each material. It's blue for PET, or it's green for HDPE, or it's red if it's a vape and you need to take it out because those vapes cause fires in MRFs. Really interesting approach that has a number of different opportunities across emerging economies where much more labour is utilised in waste management. But still, here in the UK and across Europe, there's a lot of labour that is still used. And actually, if you can make it a better job and an easier job, you can achieve more with the workers that you have, and you take more waste out of the recycling stream so that a smaller fraction goes off to be incinerated or to energy from waste.
Archipelago is focusing on the role of AI to reduce the environmental and social impact of plastic and waste. So it seems like you have a great belief that AI can have a huge impact in the world of waste, reuse, and recycling. And who would have thought all that from ChatGPT? So explain where you think AI can really change the level of the playing field there.
A lot of what we hear in the news is pretty negative around AI. The fears that actually it may reduce jobs and it'll leave us doing the bad things that we don't actually want to do and take away the good bits, the creative bits that we do actually want to do. And waste is actually one of the rare sectors that we find that it can really accelerate and have a really positive impact rather than a negative impact. Increasing the amount of waste by identification is a really crucial way in which we can bring more material back into the circular economy that just isn't possible through any other means now. If we look at textiles again, we're trying to make an investment in the moment. It's coming through our pipeline into an AI-backed technology for textile sorting. And really interesting that at the moment where you get textiles going into, bins or the Salvation Army and collection facilities, most of that sorting, in fact, almost all of it is done by hand. And they're looking at the label and they're holding the item up and they're seeing, does it have holes? Is it in good condition? None of that can be automated yet. There's very few facilities in the world that can do that through automation. So if you can get to the point where you are able to identify what that textile is through spectral analysis, through AI, recognition of what that textile is, suddenly you can unlock both mechanical recycling and chemical recycling, because chemical recycling needs really good feedstock, but you don't want to pay all of that labor cost of sorting of all of that textile waste. And equally, you have the ability to front load it, if you like. If you think of an AI database as being something which you can feed information into, a lot of the textiles in the furniture sector, for example, they have catalogs and databases themselves of what is the componentry within a fabric, within a textile. If it comes in this number of colorways, it's 20% viscose, 50% organic matter, 30% something else. If you know that already, and when the AI model recognizes that's what the textile is, automatically you know within a variance that is what that's going to be. And it can go into a particular silo. We're so excited about the opportunities that AI is going to unlock in textiles in particular.
Can you explain to me succinctly Archipelago's theory of change?
Gosh. Yes, I probably can. So, do you know, I had to print it out because it's one of those things that we worked on and is so embodied within what we do that sometimes we actually need to refresh our language. So what are the three things that we think of as our baseline in our theory of change? One is the lack of finance to achieve systemic change. 2 is the insufficient capacity to recycle plastics. And 3 is the greenhouse gases increasing cumulatively as virgin plastic production grows. And that's what we are faced with at the moment. There's very little large-scale finance going into capacity that can recycle plastics, even mechanically, even what we're producing now. We're looking at increasing our plastic production significantly up to 1 billion tons a year by 2050. We are never going to cope with what we're producing then if we can't cope with what we're producing now. I mean, in the UK, even aluminium cans, the rates are shockingly low. Like they're somewhere between 50 and 60% at most points. So why can we not recycle more aluminium? That would seem like such a basic thing. But I guess the premise for us is we know that there are solutions which can be developed, which can unlock really interesting waste streams and unlock value. If you can identify what's in a waste stream and extract more value from it, A, your profitability increases, but B, you're likely to take in more or make more investment yourself into more infrastructure. And actually, that's where it becomes interesting, because if actually it becomes more profitable, you get more players coming into the market. And at the moment, there's not that much money slotting around for infrastructure. But at some point, there will be seen to be enough opportunity in these new technologies to make that leap of faith and make it possibly a bit more attractive. I suppose what we want to have as our outputs for our theory of change, we want to see a reduction of plastic entering the economy. We want to see plastic being used more efficiently. So we're looking at reuse and return models, and we're hopefully making an investment quite soon into a pre-fill solution that would be one of the ways in which we can really see reuse and return becoming more widely acceptable in a retail environment. And of course, key, bringing waste plastic back into the circular economy, at scale.
And all of this is through technological development.
It is. So it really surprised us when we first started looking at this thesis, and coming from climate finance background, we could see we'd been on that journey through the scaling up of different technology solutions. But when we came to the plastic issue and the circular economy issue, we realized how little had evolved since the 1950s, when plastic first came into its own and started to be used more prolifically. It's really interesting that you look at texts of the period and adverts of the period, and you see that actually it was seen as this wonder material that you could just throw it away. It was brilliant. You no longer had to be chained to the sink as a housewife. There are ways in which you could eat your dinner by the TV in a plastic tray. It was seen as something which freed us. And now, of course, it's seen as something which really constrains us, because microplastics entering food chains and our water supply, entering the human body, the impacts that that has, we do not know that yet. And there is so much fear around that. There's so much concern around plastics entering the environment and the oceans and the waterways and the impact that that's having on our ocean health. These are big, problematic issues that society is really taking on board. And yet the change has not occurred in the way that you would expect it to in terms of the financing of solutions. It's still very much so that the primary source of capital is coming from VC or from aligned impact investors. Often the brands are not the ones who are putting up large amounts of capital. They are sending market signals. And you can tell by my inverted commas that I don't think that that is really a sufficient answer to the fact that this is their profitability. They need to be paying more attention to that. There's a lot of marketing-led activity that goes on, which is not going to change the trajectory for plastics. So it does need for VC investors like us to talk about it a lot, to also make it really clear that we're not doing this philanthropically. We fully expect for these technologies, these AI-backed, very sexy technologies, to change the way that we have a relationship with plastic, but also to generate really interesting returns for investors. And that is really key, because impact investing in the past has been seen as somewhere between philanthropy and VC. And actually now, you look at impact investing in the space that we're investing, our returns profiles are not subordinate to impact. They are very much market-led. And we might have a slightly longer time frame that we give the startups we're working with. We might give them more help in some areas, be very active with them, particularly in our accelerator programs where we run accelerator days and we get them all in a room and we help them understand what ESG and impact means to them so they can plan their own pathways and business development. But it's really important for us to make it clear that we do not think that you have to sacrifice returns in order to be supporting these technologies of the future.
What inspired you to launch your own company? And especially what I think is very interesting that I want to talk to you about is what led you to choose circularity and focused on the apparel industry?
Well, I always had this entrepreneurial side of me in everything. And so I kind of assumed I would be an entrepreneur at some point, but wasn't really pushing it, knew it would be a hard road. So I was kind of waiting until it was the right idea, the right thing. And other entrepreneurs will say this as well, but it was one of those experiences where I'm seeing this and I'm just like, how does this not exist? Like, how is this not already a thing? And it just seemed like such a big opportunity that I couldn't walk away from it. And so I spent a year looking into it. The reason why it ended up being a circular thesis is really what I wanted to do was create systemic change, help enable systemic change in the apparel and textile industry, which was a $3 trillion industry. So it's massive. And for me as an outsider, I wanted to focus on a single industry so I could really understand, gain the intel, the partnerships, the expertise required to pick the right companies and scale them. And before I was in food systems, and there were lots of food system funds out there. And so I hadn't seen any in the apparel space. It just seemed like this opportunity, a huge overlooked industry. And as I started to spend a year looking at pipeline, there were a lot of exciting companies in this space.
Why the name Alante?
Yeah, so I was living in Barrio Escalante, which was a neighborhood in Costa Rica, and I had a different name. So when I first started the company, I started it with an investor friend from the co-working space in San Francisco. And we had called it Vitrum Ventures. And I come up with that name because I was watching some PBS Nova episode on the formation of glass and transparency and how this whole concept behind it. And we were working together for about 8 months. And then it was clear that we didn't need to go work on this together. Like we had kind of two different visions, two different ideas. So we made the hard choice to split directions, and I was going to go forward with this idea, which was the Alante. And so I gave him the name, and I wanted a fresh start. And so I had a handful of names, and Alante was one of them, and Escalante, Barrio Escalante. It also means to scale up, and Alante is slang for to move forward, Alante. And it was time to move forward, and it was time to scale up and do this. And so that's where Alante came from.
Spanish is one of my three languages, and I've spent a lot of my life in Mexico. And I didn't recognize that Alante was forward. I guess in Mexican Spanish, I would have said adelante.
Adelante.
Give me a high-level introduction and overview of Alante Capital. What's your mission, the main activities, key strategies, and just put some bookends around it, like the number of employees and funds and structure, that type of housekeeping stuff, and then we'll drill down in much more detail.
So Alante Capital is an early stage VC fund. We invest pre-seed, seed, and Series A into startups that enable a circular and decarbonized future for design-driven consumer industries. We started with the apparel industry, Fund 1. We launched that in 2019. And we are now launching our second fund called Alante Capital Investment Fund 2. And that's going beyond apparel and looking at home goods, footwear, and the outdoor gear space, all similar supply chains, similar retail partners. We are a team, small but mighty team of 3.5. There's 4 of us, 3 that are full-time. So it's myself, my co-founder, Leslie Harwell, who's on the East Coast, and our principal, Tess Krasny, who is up in the Bay Area. And we have Lisa Bougie, who's our venture partner, who came from a long career in the apparel industry. So the 4 of us run Alante Capital. We also have a group of pretty active advisors that come with technical expertise within the industry that we operate.
So it's a distributed organization.
Mm-hmm.
Right.
Yes. We've always been remote.
So 2 funds. Are your funds open-ended?
No, closed-ended. So they're 10-year funds plus 2 1-year extensions, a typical 2 and 20 model. And the first fund, we had our first close at the very end of 2019. Eileen Fisher, who is a sustainable fashion pioneer, she teamed up with us to launch Alante. So she is a general partner in Fund 1. And then Fund 2, we're in the early stages. We've made 3 investments, making another one tomorrow as all things go well, investment committee. And we'll be, that's open for the next year, and we'll be deploying that for the next 4 years. And the plan is to have more funds after this. There's certainly more demand for our capital in this space than the capital we have available. So it's an exciting time to be right here.
Your AUM of Fund 1, do you disclose that or?
Sure. So our first fund was really a proof of concept fund. Leslie and I are emerging managers. So we did not come from a long history in venture capital. She worked in social finance at JP Morgan and was an investment banker before that at Credit Suisse. And so for us, our first fund was a small $10 million fund, just over 10. We deployed that to 12 companies that fit within our strategy and thesis. Luckily, they're all doing well, which is great. They're all still operating here, and we're in year 4 now with a lot of markups. So the performance is been good, partially because it's been a very hard time out in the macroeconomic climate, and we invest to enable resilience. Their purpose was made clear pretty quickly here with the pandemic and then, economy as it is. And then for Fund 2, we are planning to raise $35 million and invest in about 22 companies, same type of a strategy, pre-seed, seed with a few Series A on the material science side.
Who are your investors and why are they investing with Alante? Is it passion about what you're doing, or is it returns, or does it not matter?
It definitely does matter. It's both. And yeah, all of our investors are expecting venture-like returns. So we don't have, and in the beginning, that was kind of purposeful. We were really wanting to make sure that was proven out. In 2019, climate tech was still not a phrase people used. And so we were having to spend a lot of time trying to explain how we could be investing for sustainability and still make venture style returns, that this market opportunity was that big. Now we don't have to spend time explaining that. People really understand it. So our LPs we have a lot of family offices, high net worth individuals. Most emerging managers are too small to have much institutional capital. So we have to mainly raise from individuals. We do have 3 institutions in Fund 1, Fund 2, and we have a couple of apparel companies and a supplier. So I love having more manufacturers and suppliers in this industry as LPs and have their voice around the table. They are the ones that are really benefiting from these technology solutions.
Explain what the circular economy is and how it differs from the linear economy, and then what does circularity mean specifically in your focus, which is the apparel space.
So the circular economy, as opposed to a linear economy, which is what we have now, the linear economy is like a take, make, waste is what people say. So essentially there's inputs in, there's the product use phase, and then it becomes waste. The circular economy looks at the inputs going in, the product is being used, and then the inputs come out and go back in to feed a system. So it could be that they biodegrade or compost and they go back into our soil. It can be that they're recycled and go back into a feedstock, whether the same type of product or a feedstock for a different type of product. That is more of a circular strategy. And so for us, when we looked at the value chain of the apparel industry and where opportunities were, there were a ton of opportunities in the supply chain. How you make stuff, like the material innovation, like if, to make your shirt, there's the fiber that goes into it, there's the dye, there's probably some finishing chemistries to keep it from wrinkling in your suitcase, to keep the dye from, staining quickly. There's all of these different steps to go in to make your shirt. It's a big, opaque supply chain. So all of those areas had opportunity for an innovation, and I was seeing technologies out there that were addressing those spaces. There was also, though, more opportunity in looking at inefficiencies in how and why product was made, how much. The apparel industry mass produces a tremendous amount of stuff, and a large percentage of that goes into waste immediately. It's just never sold. And that was a big waste stream. I mean, if you're looking at it from a business perspective and an environmental perspective, here's an opportunity to address both with a great impact. We also looked at return. So, in the pandemic, all of a sudden, everybody's shopping online. You're not trying on your clothes anymore. So people are bracket shopping, buying 3, 4, 5 things to try them on and keep only 2. Return the rest. The problem is that reverse logistics is broken in a lot of brands, and brands, it's more costly for them to bring it back in and sell it again than it is to write it off as waste. And so that became this leakage point where perfectly good product was immediately becoming a waste stream. Not to mention all the packaging waste that was driving me crazy, because every single apartment in my block would be like just covered in, cardboard and plastic poly bags. So there was this opportunity here at moment of sale. How do we get people to buy the thing that fits them, buy the thing that they will want and wear and keep? How do we fix that packaging distribution space? And then it's in their closet, and what happens? Do they wear it once or twice? That was a huge issue that's been going on is, this, wear it once, throw it away. That's a very wasteful model. So how do we start to meet consumers where they are with a better opportunity? So can you rent certain aspects of your wardrobe if you want a never changing wardrobe? How can we make resale as simple as possible so that instead of throwing it away, having it die in your closet, it's back into the market and being used? So that moment of utility when a project's been created and it's out there, it needs to be used as long as possible for us to really have the better impact of the product life cycle. And then once it is done, how do we think about waste and processing and collection? And can it be the feedstock to the next product? And so that value chain became our pipeline. In our pipeline, we have about, the way our approach goes is that we invest about 50% material science, 50% SaaS and software that B2B that enables a more efficient value chain. And we have hundreds of companies, 1,000 companies or so now that fit within that strategy and that are early stage investment opportunities.
So that's really the scope that you're making the argument. There's more opportunity in the apparel space, primarily in the value chain, versus somebody investing in a much broader, more traditional climate-focused VC fund. And that unrealized opportunity still exists?
Oh, yeah, absolutely. For me, when we're thinking about climate, it's a lot more than just like pulling carbon out of the atmosphere. It's like thinking about where does it go? What does it go into? How do we produce less carbon to begin with? The first investment that we made is in a company called Mango Materials. I'm on the board. We invested alongside Adidas and Patagonia into this company. It was sent to me by our team at Levi's, who was our first corporate partner. So we really integrate with these brands to understand what's valuable and what challenges, we can truly address. This company uses methane gas to make a biopolymer that can be converted into a alternative for polyester fiber. And microfiber pollution is this huge issue that all the brands and humans are now concerned about. And the fiber is released into the environment, will biodegrade and go back into our natural carbon cycle, or it can have a longer shelf life and even be potentially recycled. So this is this carbon negative approach to fiber that is specific with the use case in this industry. And we have a lot of companies in our strategy that have that, but we also think about it more holistically, like inventory management and inventory planning. Make less stuff. If we just make less stuff that doesn't sell, there's a massive carbon savings in that alone. So we took this industry specific approach. Our industry is broad now. It's massive, still $4 trillion industry. But because we wanted to make sure that we could truly vet these companies. And so to do that, we became specific so we could create these very deep relationships and partnerships with a lot of brands across the space that are non-competitive. And some that do compete. There's Nike and Adidas and Lululemon and, Kering Group, Gucci and Stella McCartney. We work with them all. I'm Eileen Fisher, H&M, and we bring them innovation that they want to work with. And for us, what we're trying to do is make the best investment decision into something truly viable that can compete against price and quality specs. To get that, we need to understand from the brands what the alternative options are. What are the quality specs of a polyester fiber that they would be expecting for mango materials, for example? And then what we get to do as investors is bring these entrepreneurs, even we do this for tons of entrepreneurs that we haven't invested in. When they're exciting and compelling, we can still do it, is bring them to the right team at their customers. So, this is a perfect alternative fiber for Levi's. I know Levi's is looking for this. Let me bring you in. This is the team you need to meet. I help explain this is the stage that they're at. They need R&D funding for a pilot that's going to do this, or they need offtake agreements for whatever. And it just saves so much time. And so that's a value add that we bring our entrepreneurs, is really a vetted customer pipeline to help them scale at variety steps of that process. And the reason we can do that is because we are specific into our industry.
What's Alante's theory of change and the problem or problems that you're specifically trying to solve?
If I had to boil it down to one word, it would be waste. And waste can come in a variety of aspects, whether it's carbon, whether it's material. That sustainability aspect is huge. And so we're trying to enable a circular and decarbonized future for the apparel industry. And what does that really mean is we want to make it so that they're more nimble, more resilient, and less dependent on the fibers that they've been relying on. If we're getting virgin polyester or conventionally grown cotton, which is super water intensive and chemical intensive, what other opportunities are there to use a recycled fiber that can be as competitive as a virgin fiber? We just invested in a company that's super cool that uses the waste from potato fields that needs to go somewhere. And they've been able to figure out how to make it as a really, truly viable cotton alternative, meeting specs. And that's the first time we've seen something like that in 7 years. So we look at how do we create these opportunities for a nimble and more circular and sustainable value chain for this industry? How do we create a more healthy consumer who interacts with these products as well? So for us, it's really creating systemic change. We want to unlock systemic change within this industry. And I don't think it needs to stop at apparel. I think if you take this approach to any industry, you can do it.
One thing that I think is really different about Alante is that you don't just focus on one area across the supply chain of apparel, but instead you focus on the end-to-end circle. So how did you end up with the end-to-end circle? And then make that real to me. How do you actually do that?
I'm not a brand person. I am a supply chain person. So very early on, we had to make a choice. Are we investing in sustainable fashion brands, sustainable retail marketplaces, or are we investing in material science, software, supply chain? And very quickly, I knew I didn't want to be a brand investor. And we still looked at a lot because we didn't want to miss the opportunity if we had the chance, but ultimately felt like venture wasn't the right type of capital for that side of the pipeline. And so we became this supply chain focused investor. And when I was just spending that year, when I lived in Costa Rica, talking to everyone I could about the problems in the apparel industry, was reading everything. I was seeing the connectivity for like, what are the brand's problems? What are the consumers' problems? And I was tracking all of these startups, and I just had this massive spreadsheet, and I started to tag it in a ways that I could understand that weren't the correct ways that the apparel industry necessarily tracks it, but something that made sense to me. When I started seeing like production, distribution, use, waste recovery, like these little buckets. And I had them in these columns, and these were it was starting to become clear. And I honestly like had been just living in my Excel spreadsheet forever. And I went to sleep one night and I just like had this whole dream about like solving this thought in my head of like how it all connected for reals. It was a dream. And I woke up and was like, that's what it is. It's the circular economy of this and this and this. And it was like, how did that not already come together? But it was like, I was too deep in it. So after I stepped away from it and, slept, I saw this whole strategy that is still the strategy we have today in Costa Rica, 7 years ago, whenever that was. And that's how we launched this kind of concept around that.
You've identified 3 dimensions of impact that you're specifically targeting. The first is the environment, and then the second is labor, and then finally consumer consciousness. Explain a bit more what each of these mean to Alante, and then why or how did you decide to focus specifically on these 3 dimensions?
So these are just our dimensions of impact. Beneath them, we have KPIs on like how we track the different types of indicators. But when I started, like I cared about the environment. I was working in food systems, but it was really more the intersection with humanity that I had grown up caring deeply about. It was the farmer and, the smallholder farmer's access to being paid for what they're producing in a more fair way. Like that was the thing that really got me. So I wanted to be building this to have a social and environmental approach. Since running this company for this many years, unfortunately, the social side is much harder to invest in. So we look for technologies that can enable more social impact. We haven't invested in a ton that are pure play on the social. There's a lot of companies that do result in creating social impact by removing harsh toxins, by creating a clean environment for them to work in. We're doing a company now, I can't talk too much about it yet, but that is the most socially responsible one we've done yet. But that labor piece was important to me. That was kind of where I came from. I learned more about the environmental piece along the way. And the environmental piece is huge. I mean, that is all of our companies address the environmental piece in some capacity. And then the consumer consciousness dimension is really how do you continue to build a movement around circular economy or sustainability? And now, I mean, that was happening without us early days. And now you see it and it's so mainstreamed and it's exciting. There's like everybody knows about sustainable apparel now in a way that nobody did 4 or 5 years ago. It's just in every mall. It's on commercials. We track kind of the role the different technologies we play have in enabling that kind of continuation of this consumer consciousness shift. But underneath that, as an impact expert, like that's where I came from as a development economist, it's important to me that we track few but good indicators. We do not ask our companies to do everything and report on everything. I want very clear and concise indicators that go along with what their business intention is and that can be tracked and measured consistently over time. So usually that is directly tied to sales. And when we're investing for impact, the impact these companies have is deeply integrated into what their product is. It's not like a take one, give one type of model. It's like, no, the more product you sell with biodegradable polyester fiber for methane gas, the more carbon savings there is, or greenhouse gas equivalent emission savings there is. And so that's how we do it. Those dimensions are the higher level portfolio strategy. And then underneath them is our KPIs.
What are the KPIs and metrics that you lean on? And I don't know if you use the same set with all or if it depends on the type of tech or investment you're doing.
Definitely depends on the type of technology investment. I think it would be a disservice. And this is like a debated topic within the impact investing world because a lot of people want consistent, same indicators so we can like measure these companies against each other. But for me, it's more about like, what is the mission of that company? Like, what are they trying to do and figuring out a realistic indicator underneath that. I like it to be more nuanced like that. So they aren't all the same, but we do have a lot of GHG emissions, companies that are addressing GHG emissions. Most of them are one area within the circular economy space is like this enablement of that closed loop part, the circular materials piece, like keeping things in circulation. That was this like growing space. It's still very much new and growing, where we had to look at a lot of different experts out there who were looking at how do we say what the carbon savings is of a shirt that's not going to be bought, right? Or like, that shirt has now got another owner. You kept it in circulation longer. So what is your carbon savings with that? So we use some of like the expertise that's out there and the reporting around kind of what the equivalent carbon savings or resource savings is for displacement or thinking about the circular economy parts of our metric. And we're very transparent. So you can actually ask for our impact report on our website and we'll send it to you. And we have a very long section around methodology and how and why we get to each of these metrics.
So let's talk now about Alante's investment process. Can you walk me through the end-to-end investment process that you go through when Alante is selecting an investment? How do you source your targets? And then what's the screening process, both financial, non-financial, as you go bring it through the filter or however you envision it?
So the pipeline, it starts with pipeline, and that's, as emerging managers in this space, that was critical to us. We had to have a strong and solid pipeline so we could have good deals to invest in. And so by being the like sustainable apparel industry fund, we became a magnet. And that was very on purpose and important to us. So we partnered up with the accelerator programs. We brought on Eileen Fisher, who helped, and she put her name on this, which enabled us to get all of these brand relationships. They started sending us deal flow. We started to get our name out there. We get a lot of inbound applications for funding from very relevant companies through our website alone. And we've made it by now, we're pretty well known. In the early days, it was like, becoming that magnet was very important. And we had this lucky opportunity where one of our startups that we were talking to was doing an article for Vogue Business. And she said, "Hey, will you speak to the journalist for me?" And I was like, "Yeah, okay, I guess. What does she want to talk to me about?" And I talked to her, and we had a unique perspective in the world of sustainable innovation serving this industry that she was writing about. So we became his go-to source for her. And we didn't pay for anything, paid promotional, or PR outreach. It was all earned. And we had 2 or 3 different journals, Sourcing Journal, Women's Wear Daily, Vogue Business, where they were reaching out and we were getting quoted often, monthly. And that really helped in the early days because innovators in this space, this movement was like growing all of a sudden, and it was all of a sudden growing quickly. And so they were all paying attention and reading these articles about startups partnering with certain brands. And we were always there. And so that helped. Every time there'd be an article, there'd be a lot more people reaching out. And then, of course, co-investors, as we started to make investments, which I'll get back to the investment process in a moment, but our nuanced due diligence strategy, like being able to talk to Adidas and Levi's about the innovation that they're looking to work with while we're doing that, like was valuable to other investors. And so co-investors wanted us on the cap table. And so they were like, oh, this is they were more like climate generalist funds or sustainability funds. But when there would be something intersecting the apparel industry, they would always send it to us and be like, hey, you guys want to check this out? What do you think? Do you want to come on in? And so because of my co-founders' relationships with more seasoned VCs, we knew all these people and they became really great active sources of pipeline for us. And then our entrepreneurs ended up loving working with us and starting to send people our way too, which I'm really honored when our portfolio founders send us a great other portfolio founder. We've made some investments that way. We talk to hundreds and hundreds of people every year. Our principal has our intro calls now. It used to be me and Leslie doing that always, but now Tess will have our 30-minute intro call with that relevantly fits in our thesis. It is somewhat interesting. And then if it is, we have a weekly digest call, weekly pipeline call with the team where Tess can reports out, this is what she met with this week. This was interesting. This wasn't. These are questions. So we're staying in the loop. If there's an area where I'm wanting to be smarter at understanding, it's starting to emerge and I need to be like on top of it, then I join all those calls with her and Leslie will do the same. So sometimes we jump in if it's an emerging space. But then if it's like, oh, this is cool and interesting, we've looked at the deck, then we have our call with the partners. And so the entrepreneur will have a call with usually one partner and Tess again, and we'll dive in. They'll do another pitch for about an hour or so. We have a deep conversation and then we start it goes a little bit further into our process. Once we decide we actually are interested in investing, early on, we like to get both partners engaged. So we'll have the other partner to have, because we're the investment committee, along with one outside person. So both partners have to have a level of buy-in. And then the one who leads the deal works with our principal to actually bring it through all the way till the end and then present it to the other partner and the external IC member. So that process can take, once we've decided we like this, we're really interested, let's go ahead and move forward with due diligence. That can take anywhere from 6 weeks to 2 or 3 months because of usually the lead investor. And so if we're not leading, which we haven't led yet, but with Fund 2, we'll likely be leading a handful of companies. But we were just too small to write big enough checks. So we would be, it's that timing of like, we're going to go deep. We go deep on our due diligence. We really understand the company, where they're at, their process, there's all of that, because we are very actively engaged in supporting them post-investment. So that due diligence part is critical for us. And we have a whole process of how we kind of turn that around. And
what about your screens, financial screens, but then you have non-financial screens? Can you just speak to those a bit, or that process?
So for us, the team matters a lot in these early stages. I mean, every investor says that, but it's true. The pre-seed stage, seed stage, like the team really matters. They don't have to have everybody hired, but, understanding kind of the founders. But our screen around that, I think, is far more inclusive. So we're not looking for people with specific background. We're looking for people who think in different and specific ways, who understand the problems that they're facing, who have the softer skills that we're looking for, not just that they came from this VC fund or this Ivy League university or this think tank or whatnot. That's not really what we're looking for. We're looking for people who can open up and be partners, and be vulnerable, talk about the challenges and the opportunities, who I can trust and be able to say, yeah, we can get into this. You don't have to be perfect. There's this dynamic of entrepreneurs having to pitch investors and be perfect to be able to win capital. And that is the opposite of what works for me. So, just in me and my nature, I like to get real and get down into it. And that partnership matters. And so, there's a lot that goes into understanding the team. How do they think? How would we work together? All of that. The product obviously is critical. So there are a lot of flashy, kind of niche, sustainable opportunities in the apparel industry. It's apparel. So fashion is flashy. And we say no to a lot of it because viable, it's never going to be able to meet cost competitive. The material or the output is not durable or does not meet quality specs. And brands aren't really willing to go beyond a pilot with that. They might say, yeah, look at this really cool alternative leather made out of XYZ that is, in this collection, and they get the buzz and the marketing from that, but it's not going to go in and actually start to displace unless it can meet quality specs of the alternative leather that it's trying to address. And pricing matters a lot, and matters more than one would hope for innovation in the early days, but it really is critical in this industry. So that part we can't shy away from. So we dive deep in that, and the market has to be enormous. So when we're investing, it's in these markets, polyesters, PET, a huge market, and we're looking at replacing the polymer. So it can go into plastics. And so we're looking at a lot of different markets that these kind of applications can go into with a better feedstock, with the ability to scale. On the material science side, that matters a lot, is thinking about commercialization, cost of commercialization, and plans for scale. We take a balanced approach where we have about 50% material science and 50% software, so that we can reach the type of return expectations within the time frame of our fund that we're working towards as a VC, knowing that sometimes material science returns will be great, will be very high, but it's going to take a lot longer to get there versus something on the software side. Yeah, we really look at all of that. On the impact side, it comes down to, is it embedded impact for systemic change? And I just lived and breathed this so long that that's the easiest thing for us to know quickly, oh yeah, no, this is only something that increases sales, pass. And be oh yeah, okay, the impact is there. It's that part is not challenging because it's embedded impact. So we're not looking at something that if the CEO was changed, the impact could potentially go away. No, this is just a critical new innovation on a polymer level or on a chemistry level, so the impact is embedded. So that's something that comes up early, probably the first call. We would maybe even not even have the call. If it seemed really compelling and we weren't sure about the impact, we'd have the call, because sometimes in an area I care a lot about right now, we see impact where even the entrepreneur doing the company doesn't necessarily see impact. And that has to do with inventory planning and inventory management. and how brands are making choices about how many products and what color and what type and what style and in what location. And where we see this as this huge unlock for sustainability, a lot of the entrepreneurs out there and some of the brand teams, they just think about it as a business tool, a critical business tool for a massive industry.
How do you balance return and impact when you're selecting your investment and making investment decisions? Is it iterative? Like first it has to pass traditional financial analysis and then let's look at the impact, or is it impact first and then let's see, can we make money at it?
No, it does not. It's definitely finance first, but impact is also. So finance first, like it has to be just a solid, good business, because it comes back to the why I'm even doing this, which is for systemic change. And so to reach systemic change, like the reason why I like venture capital at all is you have to have something that can be so competitive that it outcompetes whatever inherent practice or product is out there that it's going to compete against. So polyester, plastics, like these types of chemicals and chemistries that we're looking at are massively scaled, hugely pervasive. They're in every industry. They're built for efficiency. They're super cheap. So how do we look at something that can start to replace that? I don't want to just create something small, niche, and be like, oh, here's our little cute green side of the business. Like, what can we actually look at that is a radical displacement of some of these inherent technologies? And so for us, that scale piece, which then results in scale style returns, is number one important. Like we have to find things that are just solid, strong businesses. Because if not, I mean, this is a very competitive industry, venture, but not venture, but the apparel industry is so competitive that it just won't go very far. It'll just stay small and niche, and that's not what we want. So it really comes first from that financial return perspective and the scalability, the competitive advantage, the companies that we're investing in. And then on the impact side, we just wouldn't do it if we wouldn't see something that could also, the result of its scale is transformative impact. And we have different definitions underneath what that really looks like and means. But we don't invest in anything that doesn't have the possibility of like removing a gigaton of carbon. Like we don't have any type of claim like that, which a lot of, climate funds have, because we're looking at it from this more systemic approach.
How are your investments typically structured?
Yeah, so oftentimes they're pretty early stage. So it'll be a safe, usually at the pre-seed stage. Sometimes a convertible note, though less of those these days. And the safe is a sale of future equity, so it ends up just being part of our equity portfolio. And then it's just preferred equity, usually in the priced rounds of seed and Series A companies. And we'll follow on for a few rounds. So we reserve about 50% of our capital for follow-ons, and we expect to follow on at least pro rata what most of our portfolio companies, though, at every time they are raising, we have an internal review to decide if we are going to continue investing.
Regarding your average ticket size, I quickly did the math in my head of your first fund and the number of investments, and I presume it's around $1 million per ticket.
Well, actually, because we're reserving for follow-on, for Fund 1, it would be about $500K for the Series A companies. And then we invested more in the following rounds. We would have liked to do $1 million, but we had a very small fund early on. And then in the seed and pre-seed, it's smaller. So it was $350 for a seed, $250 for $200 for a pre-seed company in Fund 1, which was a $10 million fund. For this next fund, the ticket sizes are bigger. So the pre-seed is more around $350 to $5, seed will be $5 to $750, and Series A is $1 to $1.25 about.
I think you alluded to your target returns are what you would describe as standard VC.
Yeah, absolutely. So that's what we model everything to, is return projections that can be market rate and within the time frame of our fund. So if we're looking at something that's really compelling, but we only really think we can get like not a whole lot of return, or it's going to take 12 years to get there, we can't do it. So that has really come into the due diligence phase and then also tracked throughout every quarter. And so we look at, we're targeting kind of high 20s, low 30s IRR for Fund 2. And Fund 1 right now is performing quite well, though it's still very early days for a lot of those companies because we invested initially in 2022 in a bunch of them. Some in 2019 and then 2021 in a bunch of them. But it's doing well and they're all continuing to raise. So I think we're going to have we don't have any exits yet, but we don't have any failures yet. And so I think the next year or two, we'll start to see some more of those realized exits out of Fund 1.
In your particular investment space, is there any particular standout criteria that you look for that would be different than from a typical VC things of looking for a strong team and things like that?
Yeah, for sure. Especially in like the material science side, because that is where we have a lot of expertise, is really thinking about what can scale and outperform in this space. We see a lot of companies in this area. What we're looking for is companies that can drop into traditional manufacturing. There's this kind of push for like the future of manufacturing where you like invest in things that are fully outside of the supply chain. That's not really where we operate. We're looking at drop-in replacements that can just drop into the traditional supply chain, the metal in the ground, because that's what creates this ease of adoption. And that matters a lot for the apparel companies, is this level of ease of adoption, whether it's on the software side or the material science side. And because we have a nuanced understanding of how they make decisions and how them and suppliers are adopting technologies, we have some criteria around that we look for. And that's how we de-risk the time frame of this kind of company. So it's making sure that they can scale within the time frame of our fund, is we need to see their ability to be able to drop in and scale and commercialize within 5-6 years. So we have a lot of nuanced understanding about that. I think also on the circular economy side, like we get sent a lot of technologies and people tend to focus in on one area of the innovation, like the feedstock or the process or the product. And we really look at all of it. So if it's like a company that enables recycling of something, like we still have to look at what is the feedstock, what is the market for the feedstock, understanding that everyone kind of looks at that. What is the process? Like when it goes into that black box of what they're doing, like what is the carbon footprint of that process, sort of the chemicals, the heat required, all of that piece. What is the product and how viable is that? And then how does it drop into the supply chain afterwards? And I've just noticed, I thought that was pretty straightforward, but I've just noticed that that is not always how investors or brands are looking at it. They'll look at some and not the other, and then get to a point where that thing that they didn't look at is the thing that breaks the deal. So we look at that screen from the beginning. Like there's our first check boxes when we're looking at a material science company. We've actually built tools for brands to do the same thing. If they're looking at 3 or 4 companies side by side, how do they pick which one is better? Historically, it would be like, well, we met this person at a conference and she was nice. And now it's like, well, okay, cool. But here's the 4 competing companies that are doing the same thing, because their job is not innovation and running VC funds. Their job is making clothes And so we were like, okay, here's the tool. And then we were the pipeline. So they talked to us about like, what are the competitors in this space? And then they can decide what's best for them. Yeah.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.